Welcome back to EDS, and in this video I'm going to show you how to make a lot of money with a small amount of buying power. Now there's two things that we need to do. We need to, one, write options contracts, which is going to allow us to get a high probability of success, which is going to give us consistent returns, and we want to write those contracts on futures. And futures uses span margin, which allows us to be capital efficient, which is what's going to give us high returns on our capital. So you want to open up a list of futures that have options available to trade on them. If you don't have this watch list natively provided by your brokerage or platform that you trade on, then just take a note of these ticker symbols and make your own custom watch list. And then you want to sort the list by high to low IV rank. This is because when we write contracts, we are essentially short those contracts, and that means that we want to sell high, buy low, and volatility has an impact on option prices. When Vega or volatility is high, option prices are also high, so we want to sell when Vega is high and play the contraction. One of the reasons why this works really well is because volatility is mean reverting. So once you've got your list set up like this, you only really want to look at underlyings with an IV rank of 30 or more. Anything over 30 is considered to be high. Anything over 50 is considered to be very high. I typically like to be in the mid to high range. And if you have a smaller account, you probably want to stick with things like currencies, bonds, maybe soybeans, wheat, things like that. If you have a larger account, by all means, feel free to trade anything you like. It's just that those underlyings that I listed just then typically require less buying power. So with that in mind, what I'm going to take a look at today is the British pound with an IV rank of 58.6, and it has an absolute IV level of 9%. Now, once you've selected your underlying, pull up a list of option expiration dates, and it'll look something like this. So we have our option expiration dates on the left, and then the futures contracts that correlate to those expiration dates next to it. You don't really need to worry about the specific futures contracts, as we just want to focus on the option expiration dates. Any and all good brokers will typically line everything up for you like this, so you don't need to worry about whether you're going to be using the H5, M5, U5 contracts, etc. Your broker will do it automatically. But the option expiration date that we want to pick needs to be between 30 and 60 days out in time, and there's one here with 32 days left on it, March 7th, which lines up with the 6BH5 contract. So we're going to open that up, and now we can see the options chain. I'm sure you are all aware of what's going on here, but very quickly for the beginners: calls on the left, puts on the right. We have our strikes going down the middle. This horizontal orange line shows us where the price of the underlying is with respect to the strikes. We have our expected move of the underlying in the top right corner in parentheses, and it's also visually displayed by this vertical orange bar here. These dotted blue lines show us our standard deviation levels, and we've also got positive delta on the call side, negative delta on the put side. So what we're going to do is we're going to sell one call and one put. And when we are short these contracts, or when we are writing these contracts, that basically means that we want price to stay away from them. We want those contracts to stay out of the money. And so if we know what the expected move is, we can simply just write these contracts outside of the expected move, and that's going to give us a high probability of success. The further out you go, the higher your probability of success. However, the less premium you will collect in return, and therefore your return on capital will be lower. So as a nice medium balance, I like to be around the one standard deviation level, and that'll typically line up with being around 15 to 20 deltas. So we've got a 17 delta on the call side here at the 1.27 strike, and we have a 16 delta on the put side at the 1.205 strike. Now what you'll notice is that we are pretty much delta neutral on this position. As you can see here, our contracts are sitting outside of the expected move, and they are up against the one standard deviation level. All 3 points of confluence will typically line up almost every single time, so it's a nice check that you can do just to make sure you're setting up your positions correctly. And what we've done here is created a range for ourselves, and we want price to be within this range at the point of expiration in 32 days time. And what's the chance of that happening, or what's the chance of price being anywhere within our break-even zone, which is denoted or visually displayed by this green bar here? Well, in the bottom left corner we have our POP, which is probability of profit, and that is your probability of making at least 1 penny on this trade, and that's currently at 75%. So if we were to get filled right now at this current mid price 0.006, we've got a 75% chance of making at least 1 penny on this trade. Now that's if we hold till expiration, but what if we don't want to hold till expiration and we exit early at say 50% of max profit? Well, we have a P50 here, which is not displayed for futures, it is for equities. However, your P50 is typically going to be about 10 to 15% higher than your pop. So our P50 is going to be around 85 to 90%. So we're looking at probabilities of success of between 75 and 90%, depending on how long we want to hold this position. We can also take profit at say 25%, again, even higher probability of success. That's completely up to you. I personally just like to be at around the 50% mark. And this is before taking into account that implied volatility is generally overstated compared to actual volatility. And that's going to bump these numbers up even more. And then this is not even factoring in if you decide to make any adjustments throughout the life cycle of this position. And that will also increase your probabilities of success even further. So we have very, very high probabilities of success with a setup like this. Now, how much money can we make? So our max profit, which is what we will collect in premium, is $375, and we would collect that upfront as soon as this order gets filled, and our buying power requirement is just over 1.1k. So we're getting a nice healthy return on capital. However, we can get a higher return if we want. We can go to say the 20 delta on either side, and if we do that, we will collect $481 upfront, but our buying power requirement is only 1.2k now. So our buying power requirement has only gone up a little bit, but our max profit has gone up by quite a bit more. We can even be more aggressive in terms of very high IV. We can go to say the 30 delta, and now we would collect $775 up front, and our buying power is only going to be 1.3k. So well over 50% return here, and this is in 32 days. Okay. And if your buying power requirement is too high, you can simply either just pick an underlying, a different underlying, a smaller product with less volatility, or you can go way out. You can go to say the 5 delta if you wanted to. We have a pop of 93% and our buying power requirement is $700. So you can really manipulate and play with these positions to fit your needs, but this is the foundation of how it all works, and this is how you can adjust your position. Now, in order to keep your buying power in check, we've created a free position sizing template. The link is in the description. It's available for everyone to get a copy of. And the way it works is you enter in the size of your portfolio. Say if you have a $15,000 account, you enter that, and then below it you can enter in whatever the current VIX level is, say if it's 24.1, and everything will be automatically calculated for you. So it's calculating these numbers based on the size of your portfolio and the current volatility in the market. So it's a dynamic spreadsheet, and as long as you're following this, you'll be absolutely fine over the long run. If you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium and get yourself signed up. Inside you will have access to our portfolio that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments, and everything is posted all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so if you get stuck at any point, you can speak directly with myself or with other like-minded individuals, and there's a 100% money-back guarantee. So once you have studied the full course and followed some of our trades for at least 6 months, if at that point you are not profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free, and right now it's $9.99 a month to join. The price will be increasing. However, once you're in, the price you get in at is locked in for you for life. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. And once you have learned the skill, it's something that you can take with you for the rest of your life. Nobody can ever take it away from you. And we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You are always welcome to stay and be a part of the community, but within 6 to 12 months you should be good to go. So with that being said, I will see you guys on the inside.